Okay, so greetings to you all. I thought we could study together. Um, yeah, so we continue with the topic that we are looking at, which is the cost of capital, right? The cost of capital. And I would advise that you have your calculators with you so that at least as we are going through this work, you are able to appreciate what is going on. Okay, so specifically today we are going to look at the cost of equity. Okay, we are actually going to look at the cost of equity today. Okay, remember that we have already captured um, costs of debt. Okay, and for cost of debt, we said that when you're looking at your cost of debt, you you are looking for the cost of debt after tax, isn't it? So you're looking at your cost of debt after tax, which is equal to your cost of debt before tax. Okay, before tax. Okay, and then you basically remove the tax component. Okay, so I think we did talk about this, and I think we emphasized that as much as possible, especially where we are going, where we have to use these individual costings and put them into something that will will give us a unit measure, which is the WACC. We need to use the after tax cost of capital. Okay, so basically that is that. So make sure that we are able to do that. I think it's because we mentioned, and I'm sure we'll mention again, that what was unique about cost of capital was the situation of the interests, okay, being tax deductible. Okay, deductible. Okay, so we'll be able to look at that. But obviously, we also did look at the cost of equity. Okay, we'll see if we can, sorry, the cost of preferred shares. Sorry, cost of equity is what we want to look at now. We did look at the cost of preference shares. Okay, we did look at the cost of preference shares. And remember, preference shares is a hybrid, or sometimes we call it a perpetuity. Okay, so there isn't much to it apart from sometimes we may need to adjust for the floating cost, especially if we are looking at a new issue. Okay, so if you are going to look at a new issue, then you want to account for the floating cost. Otherwise, we were able to see that things were okay there. Okay, but really, today we will eventually have to look at the cost of equity, and we are looking at cost of equity via the dividend model. Okay, we are going to look at it from the CAPM perspective, and then eventually we get to the work where we have to weight all these costs of capital, and then eventually we look at some practice questions. How do we extract these variables from the balance sheet so that we calculate our WACC, right? Very, very, very important. So we should be able to do that. But I think for now, let's quickly go into the recap of cost of debt and cost of capital. Okay, so a quick recap here. This is something that we already looked at. So like I was mentioning, your cost of debt, okay, your cost of debt, your cost of debt after tax is equal to cost of debt before tax, and then you multiply, or you basically remove. So how you remove the tax is by multiplying 1 minus the tax rate that you are given. Okay, very important that we understand that. So the rates will you can get the rate from the stated interest, um, on a particular debt or a loan, right? It can be stated, so they might say maybe the loan is at 30% per annum, okay, and then that is your before tax. But sometimes you may need to calculate it, and we were able to see that you can use the yield to maturity calculation, okay, to find the rate, okay. But really, what else are we saying here? I think we need to just always remember that the interest on debt is actually tax deductible. It turns out that we pay less than we are supposed to, okay, because the government helps us to pay a portion of our of our interest, right? Okay, and we did talk about that. Remember the tax shield, okay. And then other things to remember as we are just doing a recap here is always use the after-tax cost of debt, okay, when you are calculating your WACC. It is very important, okay. You also want to use market rates or market costs or marginal cost as opposed to historical rates, okay. This is also very important, okay. And when it comes to the issue of taxes, we know that we are not necessarily adjusting it to what's this, to preference shares or even your equity, your cost of equity. We are not doing that, okay. And so we had an example here where we had a loan of a stated interest of 18%, and then the tax rate was 30%. So to find the cost of debt after tax, notice that I don't know if you're able to see the font here, but notice that all we did was to basically look at the before tax rate, and then we multiplied by the one here minus 0.3, isn't it? I'm running out of space, but really 1 minus 0.3 in there means you are multiplying by 0.7, and this is the 0.7 that we have here. And when you do your mathematics, you are getting your 12.6 as your after tax cost of debt. And you're able to see this is significantly lower than 18%. Imagine if you used 18%, you would have overstated your cost of capital. And remember that it has got repercussion on your capital budgeting, decisions. So you want to do a very good job here, so that you don't mess things up. Okay, fine. For preference shares, like mentioned, we are saying that preference shares, really this is a perpetuity. And remember, for you to calculate the cost of preference shares, all you need to do is your dividend, okay, which is a fixed dividend. So the dividend that you're getting from your preference shares, divide by P0, okay, or the price, okay, divide by the price. As simple as that. But alternatively, like I said, if you are going to have a situation where you are dealing with a new issue, then what you want to do is you look at your dividend paid, obviously, or your dividend that you're getting from your preference shares, and then you want to account for the floating cost, which basically would reduce the price. So like I said last time, the price is being reduced, quite all right, but the cost is being increased, okay. So price will reduce, this numerator here, okay, but the cost of preference shares basically will be higher as a result of the floating cost. So that is that. So a summary is just you're not looking at any tax adjustments here. Remember that dividends are not deductible. In other words, we are looking at this This is coming after tax. Okay, so the profit after tax is what we are using, to look at issues of dividends. So there is no deductibility here. Okay, and then remember that for fixed cost, you are looking at fixed perpetuity. Okay, and it's the same logic as zero growth. Remember when we were looking at stock valuation, we said that you can have zero growth, and we were able to see how that was calculated. Okay, and then for floating cost, we are saying that it will definitely raise, okay, your effective cost of preference shares. Okay, and then ideally you find that when it comes to liquidation, preference shares get when it comes to liquidation, preference shares take priority over ordinary shares. Okay, and we're going to talk about this situation in a short while, in the next slide, I think. Yeah, so the example here that we had was a situation where you have got a dividend of 12 kwacha, okay, which is a fixed dividend, and then you have got a price of 100, and then we just say calculate the cost of preference shares. All you are doing is 12 over 100, and that is your 12%, and then we're saying no tax adjustment. I think this is very important to remember. Okay, so so only debt is tax deductible, ordinary as well as preference shares are not. Okay, so never apply this concept to cost of preference shares or cost of equity, ordinary shares. Okay, fine. So I think this is just a quick recap. So we can now go and look at what we're supposed to look at today, which is the cost of equity, okay, or ordinary shares. Okay, so so we are here. So we are talking about the cost of equity. Now you may be asked, at some point to explain, okay, why the cost of equity, and here we are talking about why ordinary shares, that is, why is it that ordinary shares are the most expensive source of capital? Okay, I think that is very important. So before we actually go to the calculations, I think it is important to understand the why, ordinary shares are the most expensive. And usually what helps us to answer this is, I know this is not really a funnel because, but I wanted to make it appear like a funnel. But anyway, I think even from our corporate law, we are able to know how the priority of claims look like. Okay, so in other words, when we get our revenue, okay, the money will first go to our operating cost. I think no brainer there. So our material, our wages, our overheads, and so on. From there, we need to actually pay interest, okay, on our various debt. Now, so we are saying that this priority of claim is answering the question, isn't it? Now, notice already here that we have our first answer. Because if we compare ordinary, shares to debt, for instance, here, debt enjoys what we call, tax deductibility. So we are paying this interest, but we are enjoying some kind of tax saving. So because of this tax shield that we have constantly been talking about, then it simply means that, debt is cheap. Okay, the cost of debt is cheap. Okay, relative. Okay, okay, relative to equity, because in equity, you know, we don't have tax deductibility. So already you have this answer. And then anyway, going back to our funnel, we go down to corporate tax. So once we address the issue of interest payments, we go to corporate tax, and then we go to, you know, preference shares. Okay, and remember that preference shareholders are getting a fixed dividend, isn't it? And then look at where ordinary shares are. So ordinary dividends or even retained earnings is coming at the very far end. Okay, at the very far end. Now, if we are to sum up the risks here, because the answer is you're looking at the risk factor. So what are the risks here? So for the ordinary shareholder, there is a risk that you are going to be paid last after all others have been paid. There is actually no guaranteed amount. Can you imagine? There is no guaranteed amount. Okay. And then sometimes you might actually receive nothing, especially if profits are low. And then also we are saying that there is no tax relief on dividends paid by the firm. Now, all these are the sources of what? All these are the sources of risk. So we have talked about four, sources of risk when it comes to equity and specifically ordinary shareholders. Okay, ordinary shares. So now we know that in finance we have a principle, obviously, that holds true, and the principle is the higher the risk, the higher the return, isn't it? And again, the higher the return. Okay, the higher the return. And we said that the return factor here is for the investor. Okay, but we know that this same return is like a mirror effect. It actually means a cost on the part of the what? On the part of the firm. So we can as well say that the higher the risk, the higher the cost, isn't it? Okay. So because it has got the highest risk, okay, that's the answer here. So why is it expensive? It is because it has got the highest risk, and the highest risk will require the highest return, and so effectively means that the most expensive source of finance. I hope this is helping and it is making sense even as you are studying. Okay, so now we can go into the calculation so that we look at the cost of equity. Okay, so now remember that when it comes to the cost of equity, here all we are just trying to do is we are getting the cost of equity by simply rearranging the Gordon growth model, which we did when we were looking at equity valuation or stock valuation. Remember that when we were looking at stock valuation, we said that the price, okay, is equal to your D1, okay, over your KE minus G, isn't it? Okay, or your cost of equity minus G. So here all we are doing is to make cost of equity the subject of the formula, isn't it? So all you are doing is you're saying that your D1 is equal to P0 multiplied by what? Multiplied by KE minus G. So here obviously you can divide by PO over PO. Okay, just try to follow me here because I don't have a lot of space. As I was preparing, it was a bit tricky. So effectively what you have is a situation where you have your KE minus G, okay, being equal to your D1, okay, your D1, okay, your D1 over P0. Now you can now remove this G so that it goes the other side, and we isolate cost of equity. So effectively now you find that your cost of equity is equal to, okay, your D1 over P0, okay, plus, okay, plus your growth. Okay, so this is a formula when you're doing when you're using the dividend discount model. So you see, you don't even need to memorize some of these formulas. You know, all you need to do is at least just, you know, be able to, you know, to see what is going on. Okay, to see what is going on, rearrange it, and you're able to see that. So we have a simple question here, and I've just given the vital information. So the question here is giving us a P0 of 50 kwacha, and then the just paid dividend, which is your D0, is 4 kwacha, and then your, you know, your growth is 6%. Okay, so all you need to do is, you know, apply in your formula, isn't it? Okay, but obviously you know that your formula is D1 over P0 plus G. Now D1 has to be calculated, and remember that D1 is found by growing your D0, okay, at the growth rate provided, and this is what we are doing here. Okay, so D1 is found by growing your D0. So it is growing at 6%. Okay, and so once you work it out, you are having a 4.24, right, as your D1. So your D1 now can come in our cost of equity formula, as you are able to see. So this is D1 divided by your price, which were already given. Once you find that, you add your growth, which is 6%, and this is what we have here. Okay, that is what we have there. And finally, when you add, this is your cost of equity. Okay, so if you have your calculator, take your time and run through these things. It's very important. You can actually even look at the decomposition of what we have just done. So when you look at the dividend yield, again, remember, it's a yield to an investor, but it is a cost. Okay, it is a cost to the issuer. So the cost aspect of this, the dividend yield, remember that dividend yield is D1 over P0, and we talked about this when we were looking at valuation. Okay, so D1 over P0 as shown here, and then this is your 8.48%, which is just here. We are just decomposing what we have done, so the different aspects of this. And then the other aspect is that these investors will have to gain from capital gains. Now capital gains is again to the investor, but for us it is a cost, isn't it? Okay, it is a cost, and so it is the 6%. We're already given the 6% as a growth rate, and then obviously your total cost of equity goes to the addition of the two, and that is your 14.48%. So easy to understand, shouldn't be difficult. Again, the adjustment that we might ask you is to account for the floating rate, for the floating cost, especially when you are looking at your new equity. So this is similar to what we were doing when we were looking at preference shares. Okay, so in your formula, all you need to do is the price should account, so your P0 should account for the floating cost. So for example, if the floating cost is 8% in this same question that we have, then it simply means that the price was how much? The price was 50, isn't it? So now we need to account for the floating rate. So you can say 1 minus the floating cost. Okay, but what was the floating cost? The floating cost were being given as so you can do it, yeah, so you can do it directly or whatever you want to do. But here we know that it is what's this? It is this is 0.08, isn't it? So if we remove 8% from 8% from 100, we have 98, isn't it? So which is 0.98. So your 0.98 multiplied by 50 will give you 46. Okay, so meaning that at the bottom here, instead of dealing with 50, you're going to be dealing with 46. Okay, and then once you find the answer to this division, you add your growth of 6, and there you go, your cost is 15.22. Again, remember what we said, that the flotation cost will reduce the price. As you have been able to see, the price has dropped from 50 to 46, but it will increase your cost, okay, because you have seen that the cost has actually jumped from 14.48, it has gone to 15.22. So those are the things just to take care of, as we are studying. Again, very easy stuff. Okay. Yeah, so that was method 1. What about method 2? So for method 2 that we want to look at is by using the capital asset pricing model, okay, your CAPM. Okay, but now this is a totally different way of finding the cost of equity, because here we are no longer looking at the issue of dividend, isn't it? We are not looking at the issue of dividend. We are strictly looking at the issue of risk. Okay, we are looking at the issue of risk, specifically systematic risk, okay, or your market risk. I think we already talked about this. So that's the risk that we are looking at. And remember that this market risk or the systematic risk is basically measured by the beta. Okay, it is measured by the beta. Okay, so we did look at this concept, I think, earlier. Okay, so things to note, it's just about the issue of knowing that this is the risk-free rate. So whenever you're doing your calculation, you want to look at what is the risk-free rate, especially that in Zambia we want to look at the GRZ securities, isn't it? If I'm not mistaken, we should be dealing with maybe 16.9, but you can try and check this as our risk-free rate. Okay, but what else do we have? We have the beta. Okay, so the beta is measuring the movement of an individual stock to the market. So if it is equal to 1, we say that it is moving with the market. If it is more than 1, then it means it is much more volatile, isn't it? But if it is less than, then we are saying that at least it's stable or it is defensive. Okay, for the risk-free rate, we are saying that really it is only compensating you for the time value of money, i.e. the duration that you're putting your money into an investment, but not the risk, because it is risk-free. Okay, the other part of the formula is the equity risk premium, which is basically your return from the market minus the risk-free rate. Okay, in short, what are you getting above and beyond the risk-free rate, okay, with this particular security that you're looking at? So we are saying that the extra return for bearing market risk. Okay, and we are saying that it is typically above, your risk-free rate. So if we are to look at some examples, again, this is easy stuff. So long as you have got this data in the question, you have got the risk-free rate, you have got the return from the market, you have got your beta, then you can just put that into your formula and be able to find the answer. So notice that for a higher risk stock, you are having a higher cost, isn't it? And then for a lower risk stock, you are having a lower cost. Again, the issue of the higher the risk, the higher the cost. Okay, so that is basically that. Okay. Otherwise, really, when it comes to which method you use, it's about the availability, the data availability. Because remember, if you're going to use your dividend discount model, then you have to have this information. Your D0, your current price, your growth rate, you should be able to have that. Meanwhile, if you're going to use the CAPM, then you're looking at the risk-free rate, okay, the market return, the beta. And then what is it suited for? So you find that the DDM approach is more for mature firms which are paying dividends, isn't it? Because remember that dividend is a key input in this formula. But for the CAPM, you are saying that it can be all the listed, I mean any listed company, so long as you are able to observe the beta. Okay, i.e., you know that you've got the Luce index, and then you see how the stock has been moving, and then you do some kind of you do the covariance. Remember, we did this in risk and return. So you look at your covariance and see if we are moving with or are not with the market. Okay, so basically those are the issues. So let's see if we can make quick progress. Go to the next slide. Okay, so I think now you have seen how we look at all the three pieces to our work. Okay, remember that your work is looking for your cost of debt, and notice that we are looking for the after-tax cost of debt. Okay, we are looking for the cost of preference shares if we have. Okay, and then we are looking now for the cost of equity, which we are just from doing. And remember that we can look at it using the dividend discount model, or we can indeed look at it from the CAPM point of view. Now, from the calculations we have done, although you noticed that I think if we were to rank them, the cheapest was debt, isn't it? Because we found that it was 7%, but it is the cheapest because of the tax shield, isn't it? Okay, now this one is mid-range, there is no tax shield, but the most expensive is our cost of equity. Okay, and we know it is because of the four risks that I talked about. Good. Now, that aside, if we are going to find the WACC, we will need to blend these costs, okay, the individual costs for the different sources of capital. We need to blend them with their market value weights. Okay, in other words, it will have to be the weight, okay, of debt multiplied by the after-tax cost of debt, okay, plus the weight of preference, shares, okay, multiplied by the cost of preference shares, and then the weight of equity multiplied by the corresponding cost of equity. So we need to find the weights, but I know now we already know how we find these weights, but we will look at them in more details as we look at some of the practice questions in this session. Okay. Yes. So in terms of formula, I think we are okay with it. Okay. But all we are just saying is that remember that all the weights, again, all the weights, you can be checking this, all the weights should be able to add up to 1. Okay. And what you want by all means is, please let us use market value weights. Okay. This is very important. Okay, unless you don't have that, can you use book value? But really, we have to always use the market value rates. Okay, and then for cost of capital, for cost of debt, I think we've already talked about this. We want the after tax cost of capital. Okay, and then how do we calculate the weights? I think this is simple. It's just about the market value of the source. Okay, so and then you divide by the total market value of all the sources. Okay, I think that is easy. Okay, and then we'll be able to look at them in a short while. What else is on this slide? We are saying that, again, another reminder, please use market values. Okay, and then you can only use book values if market values are available. Maybe if it's a private firm, yes, right, it's not on the market, then you can use the book values. Okay, but otherwise we want the market values. Remember what I said? I said that eventually, once we find this WACC, okay, we will need to compare it to the internal rate of return from capital budgeting. And the rules here are that if our IRR is more than the WACC, then it simply means that our net present value is more than 0. And in that case, then it means that this project is creating value and we can accept this project. Remember that the overall objective of corporate finance is wealth maximization, isn't it? Okay, is shareholder wealth maximization. Okay, so whatever helps us, create value or maximize wealth, we'll have to accept that. But if your IRR is equal to WACC, then you are saying that we are just breaking even. Ideally, there is no extra value, right? It's marginal. Okay, and then if it is less than that, then it is destroying value, and what you do is you want to forget about it. Okay, you want to forget about that one. All right. So that is fine. I think let us now see if we can look at a question so that this whole thing makes sense. Yeah. So let us go through a worked example. Now, this question is what I had provided in test 2. So it is test 2 of last academic year, so test 2 question 3, you can check it out. Last academic year, this is a question, a comprehensive question that I had submitted. So you can take a look at that question for more detail, but because of space, I decided to extract what was vital from that question, okay, in terms of the components of cost as well as the market value, because what the question wanted us to do is basically to calculate the WACC. Okay, so please have access to that question paper. I'm sure you already have it. Look at question 3. Now, from the given data, you notice that although it is in millions, but I think for easy calculations, we can remove the 3 zeros so that we just work with 2,000. With 1,000. So for ordinary shares, we were being told that the book value is 2,000. Okay, meaning that when we issued some number of shares, and we valued them at 50 ngwe, okay, per share, and we were able to raise 2,000. That is from the book value perspective. Again, from the ordinary shares, we're being told that the beta, okay, is 1.2, and then the market value is 1.25. Very important critical information. So that this is how you're going to be operating. Okay, another source of funds was the loan notes. So remember, loan notes, obviously this is debt, isn't it? So for debt, we're being told that the book value of this debt, okay, from our historical records in the balance sheet, is that it's 1,500, but it is currently trading at 106 per 100. Okay, so in other words, they are now trading at a premium than when they were initially issued at 100. So that is very important. Okay, and then we were given the before tax rate, which is 10%. Very important information. The last source of finance was the preference shares. According to the balance sheet, the book value is 500, and this is how much we raised after selling at 1 kwacha, okay, per share. Okay, and then what we are saying is that currently the market value or the market price is 0.92. So it has dropped from when we initially, issued them. Okay, so the next bit is on the risk-free rate. We were given as 6%, the risk premium at 7%, and then the tax rate at 30%. Okay. So now it will be very, very, very important that you do this manually in your own free time. Try to, do these calculations. So the first part, the first step, like you have seen here, I have said that the first step is to calculate the cost components. Okay, the cost components. Now, if we are going to talk about the issue of cost of debt, we are saying that our cost of debt that we are looking for is after tax, isn't it? Okay, after tax cost of debt is equal to the before tax we have been given as 10%. Okay, where is it? It's here. So we're given 10%, and then we just need to multiply by reducing with the tax rate, which is 30%, isn't it? So this one is easy, and that is why our answer here is 7%. Good. The next is the cost of preference shares. Now remember, preference shares has got, we are looking at D1, isn't it? We are looking at D1 over, okay, we are looking at the dividend, okay, over the price, isn't it? Now, how do we find the dividend? Remember that the dividend is fixed, so we're looking at a fixed dividend. So meaning that there is a fixed rate somewhere, and it is this 8%. So it is 8% of the par value, okay, that is giving us, the dividend per share in perpetuity. Remember, these are perpetual securities. So that is why here we are saying 8% multiplied by 1, okay, of course it will give you 0.08, and then you are dividing by the price. The price we're already given, the market price is 0.92, isn't it? So this dividend, the fixed dividend over 0.92, when you do your calculations, you are having this as your cost of preference shares. Now, what about the cost of equity? I think here it is easy, because you can be able to see that with the data we have been given, we need to use the CAPM, isn't it? Okay, the capital asset pricing model, because we have the beta here. Okay, we have got the beta here, and then we have got the market risk premium here, and then we have got the risk-free rate here. And that is why we are saying that it is actually going to be equal to your risk-free rate, okay, plus your beta is here. Remember that here there is RM minus RF. Now, we have already been told that the difference between those two variables is 7%. Remember, the difference between those two variables is what we are referring to as market risk premium. So it is there. Okay, and then once we add the two, then we have our 14.4%. Okay. Now, this is where sometimes things get a little bit tricky with the students. So we now need to find the market value for each source, okay, of finance. Okay, again, I always get this question: why are we looking at market values? Look, when we were calculating these, when we're calculating these costings here, we are using market rates, isn't it? Okay, so we are deriving these by using market rate. So meaning, for the sake of consistency, so that we are looking at oranges against oranges, it simply means that we also need to use market values. Now remember that the market values are being used here so that we eventually find the weights. Okay, so that we eventually find the weights. So this is very important. So what are the market values here? So if we are to start with the debt, notice that the book value of debt is 1,500. Okay, so that is the book value, but we are looking at market values. So now this book value of 1,500 was raised when we were looking at 100, isn't it? Okay, now what about the current rate, which is 106? Okay, so you just do your cross multiplication there. Okay, and then you should be able to find that at the end of the day you have the answer of 1,590 when you divide by 100, that is. Okay, so this is what you have, meaning that this is your current market rate reflecting the current price. Okay, this is very important. Or the other way you can do it is the current market price over there, the book value price, and then you multiply by the book value. Okay, and that is what you are finding. Next, we go to the value of preference shares. So we go to preference shares. So preference shares, we're being told that in the balance sheet right now, they are at 500 kwacha. Okay, fine. Now, if they are at 500 kwacha, now this 500 kwacha is because we sold them at this par value of 1 kwacha, isn't it? Okay, we sold them at this par value of 1 kwacha. Now remember that the current market price is at 0.92, sorry. So what is the current market value? Again, you cross multiply there, and then you find that this is the current market value when you multiply. Okay, next we go to the issue of ordinary equity. So again, I'm running out of space here, unfortunately. But for ordinary equity, the first thing that you need to do, ladies and gentlemen, is here we are being told that the book value is 2000, and this 2000 is from you know, a par value of 15 way. So here the trick is, it's always important to find the number of shares first. Okay, so what you are saying is that because remember that the value is equal to the number of shares, okay, multiplied by the share price. So if the value is 2000, the book value that is, what are the number of shares that we are dealing with? So for us to raise this 2000 at this price, then how many shares did we sell? Okay, that is what you are asking yourself. And 15 way is 0.5, isn't it? Okay, so if you say 2000 divided by 0.5, you'll find that the number of shares is actually what? 4000. So if these are the number of shares, well, at the moment they are trading at how much? They are trading at 1.25. So what is the market value now? So when you multiply 4000 by 1.25, you find that you are talking about 5000 here as calculated. Good. Ladies and gentlemen, you have the market values now. You have the market values now. So since you have the market values now, you can sum them up. Okay. And when you actually consider all of them, so you say the market value of debt, the market value of preference shares, the market value of equity, this is the answer that you're finding. It's 7050. So to find the weights, you are saying that you use this value as your denominator throughout. So for debt, all you need to do is the market value of debt over the total. Okay. For preference, the market value of preference shares over the total value. And then similarly, it is going to be the market value of ordinary equity over the total value. And these are the weights. So these are now the weights that we need to use in calculating our WACC. I hope it is making sense here. Really, this is very, very, very important. Okay. Okay, fine. So meaning that the next item really is just about summation, and it shouldn't be difficult. So we do have our weights, and we do have our corresponding cost, weight corresponding cost, weight corresponding cost. And that is why here we are saying we are looking at the weighted cost. So when you multiply these, okay, this is what you are supposed to find. Okay, so if you don't want to confuse yourself, always convert them to decimals. In fact, I would encourage you to convert them to decimals, make that multiplication, and then convert back to percentages. Okay, so I don't want anyone to be confused here. Please always convert these into decimals first, and then you calculate. So here, for example, here you're talking about a 0.226 multiplied by your 0.07. Okay, once you find the answer, then you multiply back your 100, and then you should be able to find this. Do the same for these, please. Okay, so you find that the summation eventually, and this is our WACC, the summation is 12.37. This is our WACC. Okay, 12.37. So in other words, here, as an expert, what you're telling this company, you're saying that on the investments, that any new investments that it wants to look at, okay, it has to earn at least, okay, in other words, more than 12.37% if it is actually going to maintain its value. Very, very, very important. Okay, so an expansion project, if it was an expansion project and you find that the IRR is more than this, then it is creating value, therefore we accept. Very, very important. Less than that, then we are destroying and we have to reject. Okay, all right. I think I didn't want to take a lot of your time today, so your task now is, I want you to look at this question. So as you are watching this video, please make sure that you pause here and look at the question that I have provided, okay, and be able to calculate, okay, to calculate the firm's WACC using market value weights, okay. And then you are looking at a project which has got an IRR of 13.5. Should the company proceed? And then you are justifying your answer. Okay, please look at this question. Okay, as a practice question, I've already put 30 marks there. And then the other question that I would like you to look at is this one. Okay, we have yet another question, but here I'm sure you will notice that we are actually going to have to use the DDM, isn't it? Okay, so again, similarly, find the answer to this question, okay, and you know, give me the answers when we meet in our next class. Okay, very, very important. Okay, due to time, I think we end here, but otherwise, yeah, these, okay, what we have done is we have looked at what's this, we have looked at cost of equity using dividend discount model, okay, and then we did look at cost of equity using CAPM model, okay. We did also look at things like the fact that debt is the only tax deductible, you know, item, especially when it comes to finance, cost of finance. Okay, and then the WACC, okay, is considering the weights, and all the weights should equal to 0. What else should you remember? We are looking at market variance. Please don't do book values. And then what is the decision rule? It is very important. And then how do you deal with it? How do you deal with flotation cost, especially when you're trying to raise new capital, either for ordinary equity or preference? Okay, thank you. We'll see you in the next class.